The focus this week is on the jobs numbers. ADP report came out yesterday, and it was disappointing. We'll be talking about this and much more with Todd Bubba Horwitz of BubbaTrading.com. Welcome back, Todd.
David, always great to be with you. It's a pleasure to be back with Kitco and David Lynn.
Pleasure to have you as always, Todd. Pleasure is all mine. 374,000 jobs were added in August, according to the ADP data. That fell short of the estimate, which was 600,000. Which was it was not a miss by a small margin, Todd. Give us some good news or bad news, whatever the case may be.
Listen, you know what? When you continue with an idiotic stimulus plan and you have a Federal Reserve that refuses to recognize what is actually going on, and you try to keep rates low and people at home, you're going to not get as many jobs. I mean, it's pretty simple when you look at it, and all the policies being run right now are to keep people away from work, because basically they're making close to or more than they would if they went to work. Places can't hire. You've got dining rooms like in McDonald's restaurants globally that are closing the dining rooms because they can't fill the help to work in them. And this is all related to stimulus. It's got nothing to do with job demand. There are so many jobs available. We could probably be at under 2% unemployment if we would quit with this ridiculous stimulus program.
Okay, so it's just a stimulus. All people need is to stop receiving paychecks and they will return to the workforce. Is really that simple?
It's that simple. I mean, look at the economy is booming. Okay, as we go forward, restaurants are packed, stadiums are packed, movie theaters are packed. Everything is packed, variant or no variant. Nobody's bothered to buy it at the moment. I mean, in Las Vegas, casinos are jammed, they're packed to the rafters. So you're really, it comes down to being that simple, that stimulus is keeping people home because those are the people that don't want to go to work to begin with. So now they have an excuse to stay home because they're getting paid to do so.
That would refer to maybe jobs that don't pay very much. I mean, we're talking about the higher end jobs that do pay a lot. There's still a lot of those people who are out of work. There's still a lot of those kind of jobs that aren't being filled as well, right? There's
jobs everywhere not being filled. Okay, everywhere in the economy there are jobs that are not being filled for one reason or another. And again, you've taken away, you've restructured some of the way that we do business, right? We don't do as much travel because they found out that they could use Zoom or one of the other manufacturers for digital meetings. And of course, you've had companies been able to cut back. But today, if you want a job and you're qualified, you can get a job.
If I want it. I've heard that one of the solutions is to raise wages to an extent that it surpasses what you would be paid with a stimulus check. But now economists, what do you think? First of all, do you agree with that?
I think it's ridiculous. Okay. First of all, I think the stimulus is ridiculous. That's point number one. Point number two is you've got companies like McDonald's paying $16, $17 an hour. Now, how are they going to make a living on those kind of wages? You know, they aren't exactly high profit items that they're selling there. They have to work on volume, and now their volume is going to be eaten up by the paychecks. This goes back to my whole theory on minimum wage, which is we're well above what the minimum wage is. There is nobody paying less than $15 an hour, and most are paying more. Okay, and that is pretty much higher than many standard wages, and many people that have jobs. The hourly wage is now greater, and some of them are offering bonuses and insurance and all kinds of props to come to work, but yet people don't want to get off their, and go to work.
I was reading this article from CNBC. They interviewed a panel of HR experts, and going back to my earlier statement, they were saying that it's not enough to simply raise wages. They're going to have to provide other incentives too. It's become that competitive out there in the workforce. So I don't know. When do you think the unemployment rate is going to come down to its maximum potential, do you think?
When they stop with the free money.
When is that going to be? When is that going to be?
Well, with this administration, who knows? I mean, this is one. We're in an administration that would prefer to have socialism. Okay, they talk bad about billionaires every day. In the meantime, if it wasn't for the billionaires, we wouldn't have jobs at all. And they talk about that they don't pay taxes, but they do pay taxes. They just do what we do. They do what every person in America does, which is to try to find a way to pay less taxes. It's not their fault that the tax code favors them and allows them to pay less, but they're still paying a lot of taxes. They're generating a lot of jobs, which creates a lot of taxes. So you can take that story from the left right now and what they're trying to preach and shove it up where, because this is a joke, and this administration wants socialism, and they want to have a one-party system, which is them, and that's not going to be healthy.
The markets don't seem to care. I mean, if you're right, I mean, if you are right in that socialism is creeping into American society, well, just objectively speaking, I think the stock markets have been liking that socialism so far, right?
Well, but remember, who supports the socialism? Billionaires support it as well because they've already got their money. Okay, this cheap money that you can borrow, you can borrow it. Let's say if you're a qualified lender, you can borrow at 2.5% or 3%, and you can make 10 in the stock market. What would you do? But the real question is the market up really because it's really up and and all these companies are fundamentally sound? Or are we up because the Fed continues to add to the money supply, devaluing the currencies and really making a mockery of what an inflation curve is and what a true free market is? So you don't really know if this market is up because it's inflationary and because it's the money plus the money supply, or is it really up because we're seeing real growth in these companies? I would say it's probably a combination, but much of it's got to do with the added money supply and QE or stimulus, whatever you want to call it, that the Fed is tapering, whatever they're doing, whatever they want to call it this week. Okay, the bond purchasing and the low interest rates are killing the country and killing the economy.
Okay, they're killing the economy. How exactly are they killing the economy? I mean, I thought the economy was on a rebound.
Well, okay. Again, think about the free market. Okay. Right now, housing markets are exploding. Why? Because, again, it's all about the monthly payment. Remember, Americans live month to month, and how much is it by the month? They don't look at what the overall cost is. When they buy a new home, they're not looking at how much the house is. They're looking at how much is the monthly payment. This is the same trap we ran into in 2008, and it will be the same trap because, again, the Fed refuses to allow the free market to work because interest rates would no way be at these levels if the market was doing its job. But the Fed prevents that because, of course, they've now got to worry about the massive debt that the administrations, and not just this one, all of them for years have created. So that money's got to be paid back. So it behooves them, because they're now political instead of the private organization they're supposed to be, to keep rates lower because it keeps our debt payments lower.
I think the key, going back to the jobs numbers, I think the key there was that even though the economy added more jobs last month than the previous month, it missed estimates. So what that tells me is that analysts were over optimistic on how many people will return back to the workforce. So tomorrow on Friday, we're speaking today on Thursday, tomorrow on Friday, the non-farm payroll reports is going to come out. And so last month, we added 940,000 jobs, close to 1 million. Do you think we'll do that again this month?
Well, they're only projecting 750. And, ADP is not a great gauge for what is to come, but I would suspect we're going to miss pretty handsomely here as well. One of the reasons that the markets continue to push higher is the Fed keeping rates lower. And if it's another bad jobs number, that does not put any pressure on the Fed to taper. Okay, that's what you have to remember. If the economic data remains poor or we're not building enough jobs, that fits right in their bailiwick and allows them to keep rates artificially low because they can justify not hiking, although the free market would tell you much different, that the rates would be much higher if they would allow the free market to work.
All right. Well, let's link this back to precious metals now. Gold, also non-responsive, still hovering around the $1,800 an ounce range. It's at $1,810 right now. So, big investors, Warren Buffett, they don't like gold. Paul Jones, I think he likes gold. Anyway, which camp are you in? Do you like gold now? I know your stance on gold. I know your stance on gold short term varies depending on your algorithm and your trading profile. So in the intermediate term, do you still like gold for the next?
I love gold. I buy it all the time. I buy physical metals all the time, not paper. I'm not a fan of paper gold because I'm not sure there's enough gold in the world to cover all the paper that's out there. However, I believe that, every portfolio should have some physical metals, gold, silver, platinum, and whatever else. But again, I believe very strongly in a percentage of every portfolio should have a representation of a hard asset commodity. And what is a better commodity? That's something you might have to use in some day in our lives for a currency. Okay. So I think, look, we were short until Monday in gold. We finally reversed, but we're still short silver, and we would be short platinum. But at the moment, but that's only from a trading standpoint. Remember, I look at one side of my trading account, and then I look at my investing. I am a avid buyer and a continued buyer of physical metals on a regular basis because I do believe in the physical metal over time. But when you have markets that are very slow, this is an extremely quiet period of the time of the year because August, everybody's on vacation. Europe is closed and many other nations are out. And even here, the big traders are gone. So I don't expect a lot here, but I do think that we will see some pretty big moves. I mean, I would tell you that I think that gold will go to an all-time new high again. Now, again, I'm not saying it'll be tomorrow. I'm just saying, maybe this year, maybe in the next 12 months. I think silver will eventually turn around. I mean, it's looked awful, but silver is kind of a wild card on its own. And platinum has been pathetic. To me, it's like on sale right now. So I think they'll all turn around at some point, and I will continue to buy them and own them. But from a trading perspective, I will trade them whatever the algorithm tells me to do.
I know you're bearish on the stock markets, and we've spoke just a couple of weeks ago, so I don't expect you to change your view already. But I'm just wondering if anything would change your view down the line. Suppose the Fed, some people say, are still very dovish. Why would you agree with that statement? I mean, are they still propping up the markets?
Unbelievable. Yeah, of course they are. With the money supply, with everything. Look, I'm not really bearish. Okay, I'm concerned. Now, let's be clear. I am always 100% invested in equities through my retirement accounts and through my long-term holding, just like gold and silver. I'm always 100% involved or invested. Now, I hedge my long-term, but I am concerned that, and I will say this for an absolute fact, I just can't tell you the date. This is the problem. This market's going to collapse. Now, when? It could be a year from now, it could be 2 years, it could be 6 months. Nobody knows the answer to when a collapse is coming, which is why I hedge everything that I'm holding long term and I trade in the short term. But I can be just like gold and silver. I can be on either side of the market at any time. But my long term, my core holdings are going to be always net long and hedged against the markets.
Well, and just to be clear, Todd, when you say collapse, I mean, what are we talking about here? Because a lot of people do. I mean, everyone expects the S&P 500 to rally, but then fall, several percentage points along the way.
50 to 60%.
Okay.
I think they go down 50 to 60% when they're ready. Now, again, when they're ready is a very tough question. I have no idea. As I tell most, they're going up until they don't.
Right.
And when they decide that the markets are going to start headed lower, they will fall like a roller coaster. And again, I could see almost an instant replay of '08. Okay, and we could get very ugly. And I think that we will. Remember, you've created this mess of a real potential of stagflation, okay, because lack of jobs or lack of workers, high inflation. So we've got a lot of things that aren't very good here. So you're going to get it. The question is when, and nobody knows that answer. It's an impossible answer.
The other question is how or why, right? I mean, if you've got modern monetary theory, which is some argue is setting in place, why would you have a correction? It's just going to keep rallying.
Well, again, you can take this Keynesian theory that they use in the United States, you can throw it in a garbage can. Okay. I mean, I'm not saying that Keynesian or Austrian is any better. I think there's a great combination and a mix somewhere that makes them all work together. But of course, you don't get the same advantage of printing. I think that's why you've seen the recent rally in the cryptocurrencies as well, because of what's going on. And the central banks around the globe, not just the Fed, but all the central banks that continue to manipulate their currency. That's a very dangerous toy that you gave them power to do, and has created nothing but grief in England since 1600. So this is This is a big problem that will eventually melt down. You cannot continue to prop up a market into infinity because eventually everybody runs out of money.
Yeah. Well, let me ask you this. So suppose we do have a repeat of 2008 and we do have a market correction in the order of 50%. I mean, it could happen. It's happened before. But every time it has happened before, Todd, in the past, 2008, 2001, 1987, it's always rebounded and hit new highs down the line. What about the next time? Do you think we'll have the same?
I will go with the theory, David, that the stock market since the inception, okay, it's 170 some years now, goes up approximately 8% year over year. And I will continue that it will go up 8% year over year. There will be new companies that will come in. There will be new technology. Something will change. But basically, the markets will continue to perform over time. And if people remember that it's time in the market, not trying to time the market, the same thing for the precious metals. We cannot time it to an absolute certainty, but knowing that its value will grow allows us to hold as long as we do not overinvest and take too much leverage, which is usually the biggest problem for most.
I'm going to end it on this question, Bubba. Suppose stock markets do grow at 8% continuously over time into perpetuity. Wouldn't that make the U.S. stock markets a better inflation hedge than gold?
Well, again, you have to describe how you want to just take inflation. Okay. A lot of the stocks and companies go up because of the inflationary things around the globe. Gold has some real value as besides jewelry, right? It could be a currency. We may be in a position someday that you may need to have gold, silver, and other metals as real currency because you've got some major issues floating around in this country. Now, gold and silver have not reacted to what's going on, but I don't expect them to. I mean, the price action will tell you, but the markets have been through 1929, 1987, and many other crashes, 2001, and they've always come back. And I don't think this time will be different, and I don't think this time will be different from the downside. It's going to melt down at some point, whether it's from 40,000 or 80,000, who knows the number, but we know that a lot of is built on inflationary times and not just the fundamentals of companies.
All right. Excellent. Excellent thoughts today, Todd. Thank you so much for coming on.
Appreciate it.
And thank you for watching Kitco News. Don't forget to subscribe and follow me on Twitter at DavidLynn_TV.